This is not financial advice. Do your own research, verify primary sources, and make decisions based on your own risk tolerance. Now let's begin with something most analysts are missing. Silver is no longer trading as a simple commodity. It is transitioning into a strategic asset class. And that transition changes everything about how price behaves. In the past, silver moved primarily on three forces: inflation expectations, currency weakness, and speculative positioning. That framework worked for decades. But over the last year, a fourth force has quietly overtaken the others: industrial indispensability. Silver today is not just a store of value. It is an input, a non-replaceable one in many cases. It sits inside advanced weapon systems, renewable energy infrastructure, semiconductor fabrication, EV production, and telecommunications networks. The more technologically complex the global economy becomes, the more embedded silver becomes. That matters because markets treat inputs differently than they treat assets. An asset can be sold. An input must be secured. When something becomes essential to production chains, price volatility becomes a policy concern, not just a trading concern. And here is where the first structural shift appears. When policymakers begin discussing mechanisms that resemble price stabilization for critical minerals, they are implicitly acknowledging that free market volatility is no longer aligned with national strategy. Governments do not defend price floors for decorative metals. They defend strategic resources. If a government signals that certain minerals are too important to allow disorderly pricing that alters downside risk perception, it introduces a psychological backstop. Even if no explicit number is announced, the mere existence of stabilization language reframes investor expectations. Markets respond not only to policy implementation, but to policy intent. Now combine that with recent volatility. Silver experienced one of the sharpest drawdowns in modern trading history. That kind of correction usually signals the end of a cycle, but what followed was not abandonment. It was stabilization discussion. Think about the sequence: violent sell-off, public policy acknowledgement of strategic importance, international coordination discussions. That is not a random order of events. It suggests policymakers observed the instability and concluded that leaving critical minerals purely to speculative forces may no longer be acceptable. This does not mean prices cannot fall again. It does not mean markets are controlled. But it does mean the floor is being debated at levels of governance that rarely intervene unless something larger is at stake. And here's the deeper layer most people aren't considering. When a commodity becomes strategically protected, capital allocation behavior shifts before price does. Miners invest differently. Industrial buyers contract earlier. Governments stockpile quietly. Investors reassess long-term supply curves. That shift begins slowly, almost invisibly, in boardrooms and policy meetings long before it becomes obvious on a chart. Now ask yourself something critical. If silver were truly entering a prolonged bear market, would governments be discussing stabilization frameworks? Would they be coordinating across allied nations? Would they elevate it to national security conversations? Or would they simply let the market clear? The answer matters, because markets don't reprice on headlines. They reprice on structural shifts in how capital flows toward production and security. And once that shift begins, it rarely reverses quickly. We are not looking at short-term momentum here. We are looking at a potential change in how silver is categorized within the global economic system. Speculative asset or strategic infrastructure. The moment it crosses that line, valuation logic changes, and I believe that line is being crossed quietly, in real time. If this framework is correct, then recent volatility was not the end of a cycle. It was the stress event that triggered a new phase. The next question is whether corporate behavior confirms that thesis or contradicts it. Now let's move away from policy language and look at something harder to manipulate: operating results and order flow. Because if a structural shift is happening, it will show up in numbers long before it shows up in headlines. Start with the producers. When a major silver miner reports realized prices meaningfully above benchmark averages, that is not a rounding error. It is not marketing language. It is audited revenue. And realized price tells you something extremely important: what buyers are actually willing to pay in real transactions. There is a critical distinction here. The futures market sets reference pricing, but physical contracts settle real supply. If realized prices begin to drift above futures benchmarks in a consistent way, that implies buyers are prioritizing guaranteed access over exchange-based exposure. That is how procurement departments behave when supply certainty matters more than marginal price savings. Industrial buyers do not chase momentum. They secure continuity, and continuity is expensive when supply chains tighten. Now add another observation. When miners increase exploration budgets, optimize balance sheets, and double down on primary silver exposure, they are not reacting to yesterday's candle on a chart. They are positioning for multi-year demand visibility. Mining investment decisions are forward-looking. Projects take years to develop. Capital allocation signals management's confidence in long-term pricing stability above cost thresholds. If executives believed the recent volatility marked the beginning of sustained price compression, expansion spending would slow. Instead, we are seeing strategic reinforcement. That matters, because capital flows toward production when pricing durability is expected, not when collapse is anticipated. Now let's shift to distribution. Physical bullion dealers operate on inventory velocity. Their entire business model depends on predictable fulfillment cycles. When large dealers experience shipping delays or inventory compression during price spikes, it reveals a temporary imbalance between demand and operational capacity. But here's the nuance that separates structural stress from emotional spikes. Was demand driven by speculative frenzy or by allocation shifts? If retail participants were simply panic buying, delays fade quickly once sentiment cools. But if buying is part of broader asset reallocation toward hard assets during volatility, then each recovery in price invites renewed accumulation. And that is where cycles begin compounding. Because every time demand surges faster than supply pipelines adjust, inventories thin slightly. And thinner inventories amplify the next demand wave. Now layer in the derivatives market. Options positioning tells you where risk is clustered. When significant in-the-money call exposure survives a major price drawdown, it signals that bullish positioning has not been fully extinguished. Normally, sharp corrections clear speculative leverage. If large blocks of call exposure remain active even after aggressive selling, that suggests underlying conviction, or structural hedging, remains in place. Each futures contract represents 5,000 ounces. Multiply that across open exposure, and the notional influence becomes meaningful. Most contracts settle financially, that's standard. But when futures pricing diverges from physical valuation, even modestly, incentives shift. If physical premiums rise relative to futures pricing, exercising contracts becomes economically rational for sophisticated players. That doesn't mean everyone will demand delivery. It means enough participants might consider it to pressure the system psychologically. Markets run on confidence in settlement integrity. If enough capital begins testing that integrity, volatility accelerates, not necessarily because supply disappears, but because trust becomes part of the equation. Now step back and observe the alignment. Policy discussions suggesting stabilization, miners realizing elevated effective pricing, dealers navigating fulfillment surges, options exposure resisting full liquidation. 4 independent channels. Same directional undertone, tightening conditions beneath volatile pricing. This is how structural repricing begins, not with straight-line rallies, but with repeated stress events that fail to break the underlying thesis. If silver were structurally weak, volatility would produce apathy. Instead, volatility is producing policy response, capital reinforcement, and persistent positioning. That combination is rare. And when rare combinations appear across policy, production, logistics, and derivatives simultaneously, they deserve attention. Now the real question becomes timing. Structural shifts do not unfold in a single week. They evolve over quarters, sometimes years. But once the market begins transitioning from speculative pricing to strategic pricing, the floor moves gradually upward, even if volatility continues. So here's what you need to think about. If silver is increasingly treated as infrastructure rather than a trade, if procurement certainty becomes more important than marginal cost, if capital expenditure signals confidence rather than caution, then recent volatility may not have been a peak. It may have been the reset that forced the market to reveal its structural importance. The next phase depends on whether demand resilience continues through volatility, and that is what I will be watching next.